Light FM. It's hot already. It's 79 degrees, and I got hazy. Well, now it's almost sunshiny outside for the moment. 70% chance of rain today and a high up about 94. I really hate to be the bearer of bad tidings, but facts is facts, right? Advisory services offered through Second Half Financial Partners, LLC, an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. Yeah, that means it's time for us to check and see what Wall Street's doing to your money today. It was not a great day yesterday on Wall Street, but it could have been a heck of a lot worse given the other events going on. On the telephone with us, Phillip Statler from Statler Financial Services. I missed you the last couple of days. So good to have your voice back and be back with you on the radio, Phillip.
Hey, good to have you back. Hope you hit them straight and at least stayed on the fairway most of the day.
It was at least close to the fairway, which is probably about as good as I'm going to get. I don't really get this. We were chattering about it before we went on the air. Big tariffs went on. The mainstream press is busy telling everybody we're all going to die because some of our best friends have 35% tariffs slapped on imports. And yesterday it was not a great day on Wall Street, but the Dow going down 224 points is not really an earth-shaking fall. Standard & Poor's was off by a rock-crushing $5, so you got to call that flat. And the NASDAQ boys were actually up for the day. We got to have priced in these tariffs already, and Wall Street is kind of giving the president and all the mainstream press a big yawn, aren't they?
Yeah, they really are. I mean, that's right. The markets really didn't overreact yesterday at all. So either two things. One, either, like you said, they've priced it into the market already, or two, they believe they're not going to last, that they're going to get reversed eventually, or they're going to be less than what is anticipated, and they've built that into the model. So either way, there was no big reaction yesterday.
No, I was honestly quite surprised. But then, back up and think for a moment. I mean, we all of a sudden back in April, we already slapped basically 10% tariffs on everybody across the board. So our tariff policy took a major change more than 4 months ago now. So it also could be that we're flat out just getting used to the notion, don't you think?
Well, it could be that too. I mean, it's the ups and downs. We've just got to the point where it's not it's a non-event at this point.
It really does sound that way. Although it's kind of fun looking at the different sectors down the line in the market as well. I mean, if you've got a really import-dependent business, obviously your stock is suffering by a little bit, and I would expect that in the tech sector. But one of the more credible analysts that are out there, you found this morning, talking about how our tech sector on the stock market, I mean, it's absolutely booming, and that was the area that we were thinking we were going to have some problems with, right?
Well, it is. They call it TMT, and that stands for technology, media, and what's the last one? I forgot what the last one is right now. Telecom. So that's the three.
Oh, I thought it might be taco. I thought it might meant tacos. So, yeah.
So anyway, they say if you look at the forward-looking earnings per share or PE ratios looking forward, that it is I'll just quote, here's a quote: risk highest since bursting of dot-com bubble, is what this one analyst, this technical analyst, is touting. And we've had this conversation in our office several times, is that, the technicals are now really agreeing with the fundamentals, and that this market is just frothing. And the question is, when do we get that 10-15% correction? Because we're due. I mean, yes, we had one back in April when we had this big, tariff thing, Liberation Day, but that wasn't enough to justify the numbers we're seeing now. And I know I've seen headlines that, some of the big guys are liquidating and going to cash. And so the question becomes, are they right? You don't know.
But Yeah, especially with tech-based stocks, investors do have a tendency, and it goes in cycles, to get way ahead of their skis as far as making profit and price earnings decisions on tech stocks. They're looking way ahead of their skis on that, and we're going through that phase right now. All you need to do is say we're figuring out how to monetize artificial intelligence. Doesn't mean we have, just means we're thinking about it, and that'll pretty well get your stock up. We saw that happen to Facebook when they auditioned their new artificial intelligence bot, and they just had an absolute party after Facebook's earnings release earlier this month. And we're kind of going through one of those cycles right now. You and I have been talking about how we thought the tech stocks were getting overvalued for quite some time now, and a lot of the tip sheets have been saying the same. Now we got some technicians that actually look at the numbers and crunch them and say, well, maybe if you're going to stay in equities, maybe looking at some of those other stocks that are doing 10% earnings increases this quarter might not be a bad idea right now.
Well, it is. And, I tell you, there's just a lot of different things going on out there. I want to talk about one other thing. I meant to get to it yesterday and got sidetracked trying to just keep talking, on the radio. Sometimes that's hard.
Been there.
But I wanted to talk about this yesterday, and I just totally lost time constraints. So debt, credit card debt is we're seeing defaults are soaring. So we're the average, I won't say the average, the U.S. household right now is carrying almost, not quite, but almost $1.2 trillion in credit card debt. And figure that those interest rates are somewhere between 20 and 40% on a credit card right now. That there's most of the families in this country are barely scraping by month to month. The retail numbers have been good, but it's got to be going on plastic, and at some point, Dave, that's going to catch up. Or the other issue is, families are just one day away, one event away from default. You lose your job.
When you start trying to service that kind of debt at those kind of rates, I mean, 2 weeks of unemployment can be a disaster, even if you can find another job quickly.
That's right. Some big medical event happened. It doesn't take much. So many families are on that brink and just teetering with credit card debt right now.
And that kind of dovetails off of the unemployment count report that we had yesterday morning. We ticked back up again on first-time claims, but the continuing claim number kind of scared me. For the week ending July 26th, the numbers that we got yesterday morning, 1.974 million continuing claims for unemployment were filed, and that's the highest since November of 21. I mean, when we start having to go back 4.5, 5 years before we can match those numbers, it does say that our unemployment the employment picture is at the very least slowing down, which the Fed was trying to do. But at 4.2% unemployment, we kind of overshot the 4% number by a little bit.
Yeah, we did, and I just picked up this number too. So first 9 months of 2024. And that's a year ago now, really, lenders wrote off $46 billion in delinquent credit card debt. That was a 50% increase over the same time period in 2023, and the highest we've seen since 2010.
That's truly scary. Because I've been in that position where I've been fighting credit card balances down. It's no fun whatsoever, and I was employed at the time, but trying to do it when you hit a bump in the road like a jobless stretch or a medical emergency, that's scary. On the national front, we did have a little bit of news. We have one more seat on the Federal Reserve Board filled, and needless to say, it's a President Trump advisor. The head of the Council of Economic Advisors, Stephen Mirren, ends up taking the vacant position on the Federal Reserve Board. That's one more governor, at least until January, and we can assume past that. That's going to be a vote in President Trump's seat, be yelling for more interest rate cuts, which, given what we're seeing on unemployment right now, almost is, I won't say advisable, but at the very least a very feasible course of action in the September meeting.
It is. I noticed yesterday the statistical numbers going up I think I saw that it had gone to 91% probability that we'll see a rate decrease in September.
And that's a big change from the 83% that I had when we spoke last back on Tuesday. So, yeah, the odds are starting to get up there. And that unemployment number tends to confirm the revised numbers that we got out of the Bureau of Economic Statistics that cost that lady her job earlier this week. I mean, it helps to remember it's not the fact that the numbers stunk. It was the fact that 2 months ago we were dropping. We're now changing numbers from 2 months ago down like 80% after a Federal Reserve decision that probably would have been changed if they'd seen it. See other stuff going on here. President Trump put an executive order in yesterday saying that our 401ks can now include Bitcoin, real estate, hedge funds, private credit. I'm kind of thinking a lot of people are going to be taking some untoward chances on their retirement portfolios off of that little change in regulation, don't you?
Yeah, we talked about that yesterday, that, even though he allows it, the one thing people have to understand, it doesn't make it mandatory. So every 401k will have its own, the fiduciary trustee will have the choice of whether or not to offer those or not.
That's repeatable. I'm going to stick with my nice conservative funds. I like the way that my money's going. It's up slowly. It may not be beating the market, but it doesn't lose either. Tidbits out there this morning. Toyota issued some revised profit guidance. They slashed their 25 profit guidance. Couldn't imagine what a $9.5 billion tariff hit would do, but the good news, mortgage rates actually fell a little bit last week. I'll take what good news I can find.
Yeah, absolutely. Absolutely. It did. I think it was the lowest in the last 6 months, I think. I got a couple of things come out that just hit my news tape for earnings. I know we were going to start with Block, but I thought maybe we would start with the big losers of the day first.
Sounds good.
Yeah, the Trade Desk, which is a firm that I'm not exactly sure what they do anymore. I know it's a popular stock. It's a back end thing that works with companies and things like that. But they must have had a bad quarter. Something happened other than just getting downgraded, because they're trading down 33% this morning.
Crapola. I'm glad they're not so big that they can move an index. Imagine what that would do on the Dow.
But you add that with Under Armour. Under Armour had a not so good report. They earned 2 cents a share. That was lower than expected. They're expected to make 3 cents a share. They missed on revenue. So Under Armour is down almost 22% this morning. You're just Mary
Sunshine all over the place today.
But let's look at Expedia. Now, Expedia is the other end of the spectrum. They beat on earnings, beat on revenue, topped expectations. They raised their full year bookings and revenue guidance. And so they are getting rewarded today, up 14.5%.
We'll take some good news down the process. Now you're going to have to tell me whether or not Block is H&R Block or the other Block.
This is the other Block. This is the Square Block.
That's
so it. The Cash App, they own Cash App, and they beat on earnings and revenue as well. Growth is good for them. They raised their full year guidance. They're trading up a little over 7.8% this morning.
We'll take that happily. Resetting the table for the morning. Off day on the blue chips, up day on the more adventurous stocks yesterday after the tariffs went on board, which still doesn't make any sense to me. 45 minutes before the markets open this morning, what are we looking at?
We got a little green ink this morning, Dave. Not huge, but it's green. Dow up 0.2% of a percent. The S&P 500 is up 0.25%. The S&P 500, the NASDAQ 100 up about 0.2, and the Russell 2000 up about 0.6%. On the other side of the coin, we got silver up almost 0.5%, back over 38 again, $38.46 an ounce. Gold's up almost 1% at $3,486 an ounce, and then crude oil down significantly from yesterday, but up about 4/10 from the close, $64.12 a barrel.
I just want to compliment you. You did a great job jawboning the price of oil down while I was gone. I appreciate that. Because
We try. We try.
everybody who's anybody listens to us, of course. Overseas markets, the Asian Rim market is generally off over the overnight hours because, well, a lot of those countries are on the tariff list. Japanese markets were up by almost 2% because we got to deal with them. Europe, on the other hand, is feeling okay. Your average European index halfway through their trading day, fractionally up by about 0.05%, but green, and that's good news. Filling in my retirement plans so that I can turn my dreams into plans takes a little bit of advice that I don't have available to me. How do I find you to get that advice, Phillip?
Then give us a call, 863-382-0037, to schedule your core retirement analysis, and then join us for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
And you and me together again next week with Fill In every morning on Light FM. Thank you so much, and you have a good weekend, sir.
All right, buddy. Have a great day.
Take care. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Okay, so I want to thank you for joining us today. I'll be out for a couple weeks for some eye surgery, but I look forward to speaking to you soon. Take care now. Bye.